this is David Bronstein, and I'd like to welcome all of you to our webinar event today, Private Health Insurance Exchanges, Consumerization via Defined Contributions. Our speakers today are Ashish Kaura, Vice President and Partner, Booz Company, and Akshay Kapur, Principal, Booz Company.
So let's talk a little bit about adoption and market drivers. What do we see happening in the market today? What are the big forces that are impacting the emergence of private exchanges? The way we like to think of this as a marketplace really is, on the supply side, which is the payers and intermediaries, those who supply the health insurance product. And on the demand side, we broke out consumers and employers separately because I think there are different drivers and different motivations on the demand side. So today, what we see, at least on the employer side, starting with the employers, there's really two big drivers of at least a thinking of a need for some of a defined contribution product. Not a surprise that cost clearly have been rising high, and this defined contribution is a means to both cap the risk as well as pass on some of that risk onto employees. And when we speak with employers today, the sense we get is they understand the defined contribution product. They do have questions about it, but they see that as a stepping stone or a step down from providing full insurance benefits today towards curtailing those benefits, but in a way that it still keeps their role and their ability to influence those choices alive. So still the employer is trying to maintain some degree of role within the health benefits world, but really seeing it as a step away from providing full benefits. On the consumer side, as they've gotten more, as more risk is being shifted onto them and as they are being held more accountable for the health insurance choices, I think there is, in general, a greater desire for understanding the cost-coverage trade-offs, understanding, getting some guidance on how to make these choices. And there is also a general belief when we talk to consumers or when we do a survey that public exchanges versus private exchanges are in general more geared towards consumers, being run by private enterprises, and will do a better job in meeting those needs. So I think on the demand side, there are both cost pressures and some proclivity or some ingoing assumption that private exchanges would be more efficient in meeting consumer needs. On the supply side, which is payers and brokers, we hear some mixed reports right now. To a large extent, we think payers today are somewhat being dragged into taking a look at private exchanges. The desire there is really to limit the extent of dumping today, where they don't want groups to fully exit the business of providing health insurance and become more of a individual consumer-oriented market, with the hypothesis that the consumer-oriented market is tougher to make money in. There's greater pricing pressure, there is more cost transparency, and in general, more margin pressure. So we see from a payer clientele a desire to keep group within a group, and defined contribution may be one means where they can still carve out a role for the group, still at least do the first sale and the first negotiation with the group, and keep that group role alive and well, and not fully bleed over that volume to the consumer market. For brokers and others, I think this is really an opportunity to maintain the value add, I think, where we've started out seeing models where we felt that brokers would be less relevant in exchanges going forward. I think our view is that brokers will still continue to maintain a fairly robust presence. That doesn't mean that they will continue to do the business the same way, but I guess it just means that the value add and what they bring to the table will need to change. But again, I think brokers see the maintenance of the group model as a means or of maintaining their role in some more traditional ways, and are also looking at private exchanges or defined contribution as a means to continue that. What is the current action? I'm going to walk through the next few slides fairly quickly. I'll pause on a couple of slides where we want to have some discussion. But page 8 on the screen on the supply side, we've clearly seen a lot of interest now in the whole concept of private exchanges, and I think fair for us to say we've seen interest from 3 broad categories. We've seen interest from the traditional large national benefits houses such as the Aon Hewitts and the Towers Watson. Some of those are fairly public, where they've taken some early leads in establishing different kinds of private exchanges. We've also seen interest from the payers themselves, and we'll talk a little bit about next page on what are the different kinds of exchanges, but the payers are looking at defined contribution and as a means to keep group within a group and understanding what they could do there. And finally, I think we've seen interest from, I would say, a broad category of others. These could be either technology platforms that want to sell their services to payers or benefit consultants, or in some cases we've actually seen interest from smaller producers, smaller regional producers that may have a large local market share to say what kind of products or what kind of platforms do they need to have in place to galvanize a shift to private exchanges or defined contribution. On the next page, we talk about where we see the market headed in terms of the kinds of private exchanges we see emerging. Broadly speaking, we divided the world into 2 types. One, I would say single carrier or really proprietary exchanges, which are really one carrier selling their own product in a defined contribution format, but potentially giving having 10, 15 or more different kind of products under that umbrella, but it's one carrier promoting their own exchange, if you will, exchange in quotes. And the second is more the multi-carrier, more of the open marketplace kind of a model, which is right now being driven by the likes of Aon Hewitt, who are trying to build a marketplace truly, combining different kinds of suppliers, payers, and pulling together different kinds of demand groups into one platform or one online marketplace. So let me talk a little bit about what we see as the big differences in these models, and then invite my colleague Akshay Kapur to add to this. So Akshay, do you want to walk through what the big differences in these 2 models?
Yeah, sure. The single carrier exchanges, typically what we are seeing in the marketplace are offering group-based products, and as Ashish pointed out, their interest really being that they want to preserve the employer-sponsored insurance model as far as possible and the benefits that it provides to both employees and employers. The multi-carrier exchange model, on the other hand, started predominantly in the retiree segment. So Extend Health was one of the models, and you would see individual Medicare Advantage products on that model. Having said that, Aon Hewitt, likes of Aon Hewitt, are pushing pretty hard on group defined contribution solutions targeted to mid and large size employers. So we are seeing that market change a little bit. In terms back on single carrier exchange, the typical number of plan options that you'll see from any carrier, about 3 to 5, and limited to that insurance plan that offers the single carrier exchange. Multi-carriers, on the other hand, you might see like 10 different choices of products across multiple carriers, 2 or more carriers, so that would not be uncommon. In terms of the value proposition that a single carrier exchange would pitch to an employer, first being the level of employer involvement, you could consider that to be, anywhere from passive to active. The whole argument that a single carrier exchange would make to an employer is that you continue to play a role in the provision of healthcare benefits to your employees. However, we can take care of some of the administrative complexity areas, such as benefit design and selection of product choices. Multi-carrier exchanges, on the other hand, their value prop is expected to be going forward to employers saying you can take a more license-fair approach, more hands-off approach to offering product options to your employees. Leave the selection of carriers to us. You can leave the selection of product choices to us. We'll take care of the enrollment, the billing, and therefore, those employers that are looking to do that, short of, dumping employees to the public exchange, they may be good targets for a solution like a multi-carrier exchange. So those are the key points wanted to make here around the major differences between these two types of exchanges.
Great, thank you, Akshay. The next 2 pages are really a click down on each of the emerging exchange type. So page 10 on the screen, let me just get to that. This is really talking about the single carrier exchange, which is one carrier providing its products in a defined contribution format. And I think where we are seeing this model really go, if you look at the examples, it's really a number of pairs that have large regional market shares, such as the Blues, where there is still some concern that a large multi-carrier exchange would commoditize the brand, would commoditize the product, and hence the first stop really there tends to be to create more of a single carrier exchange, and you see some examples of that on the page. And we are coming up on the next slide where we'll pause and take questions. So if you look at the example on multi-carrier exchanges, these are today largely being driven by benefit consultants, i.e. the intermediaries. The target segments tend to be group, but they're also targeting group retirees. And typically, the products that are offered are much greater in number than what you'd find in a single carrier exchange, again, as you'd expect.